Welcome to No Fluff, Just Ideas. This is your host, Sophocles, and we're going to be discussing investment ideas from around the world. So buckle up and enjoy. This podcast is for educational purposes only. Full disclaimer at the end of the podcast. Well, ladies and gentlemen, I have Marcel Gozali here. Marcel is founder and chief investment officer of Stone Sentinel Capital in Singapore. I recently saw him at our event in Brazil. I always find your ideas super interesting, Marcel. It's always a pleasure talking with you. So welcome to the podcast. Thank you for accepting the invitation to present.
Oh, yeah. Of course. The last time we did this, I pitched Grupo San Jose, which is a construction company based out in Madrid, in Spain. I think the stock did pretty well.
Yes, well, it was around 550. It's 9 now. It's almost double from when you presented it.
Exactly, yeah, it did pretty well. I would say that it's mostly just an earnings story.
That was fantastic.
Not really. Yeah, it's a great earnings story. I'm actually no longer in the stock right now. I'm long a different construction company now, an even more interesting one based out in Taiwan. An even more interesting one, yeah. So maybe for the next episode we can do that.
Yeah, I mean, sure.
Yeah.
Don't get me wrong. I think all your ideas are interesting.
Good.
Yes, and when you told me, yeah, sure, I got this idea and this idea, when you mentioned that, I thought, okay, which of these ideas might be more interesting to a wider crowd? And that's why I thought this one was, even though that other one you mentioned to me in the chat is super interesting as well, I thought this one, because of the liquidity, might be a little more
Sure.
Yeah.
Sure. No, it's fine. I get what is it that you're looking for. I think Ascentech is more like it's more suited for your channel because it's more like value based, and the stock is down since the last time that I spoke about it. So it really has like a good value angle to it.
You know, the thing is, it's like what I notice it can be very sector driven. Like I was looking at my positions the other day, and all the ones which were not doing so well were basically in sectors which were struggling. So it's
good.
It's the market is really just rewarding a few sectors.
Right. And you can choose to include this part of the conversation in or outside of the podcast, whatever you choose.
Okay, no, that's great. I need to make a separate list of all the people pitching and then give them a shout out. I've been so busy. As you know, I'm trying to put on another online event in October,
right,
which is a game.
Oh yeah, it's coming up. Yeah,
it's basically for all those investors who don't want to pitch or share ideas. They just want to sit and watch. That's what the online is for. You don't want to travel to Brazil. You don't want to travel to Cyprus. You don't want to travel to China. You just want to sit and watch.
Right.
And that's what that is. But I put 12 investors like yourself are going to pitch ideas.
You may have to include me more in the online events in the future because I will have to do less travel.
No, I completely understand. I mean, I think really an investor can only do max 2-3, is pushing it, events a year. And for those listening, there's an early bird special of €99 until the end of the month. And I'm including 6 replays from prior online events. So someone will get like 18 basically different pitches and stuff to listen to. Anyway, so on to the idea, which Ascentech.
Yeah, right. So and I guess I can just start with a quick overview of what Ascentech does and why I'm interested in it. So in one sentence, Ascentech is the Japanese operator of Citrix software. So Citrix software is one of the dominant players in a particular niche in the software industry called VDI, or virtual desktop infrastructure. We'll go a little bit deeper into why this niche is important a little bit later in the pitch. But in one sentence, this is what it does. A Japanese operator of Citrix software. And Citrix software is actually owned by a CSG group, a cloud software group that's based in the United States and owned by two dominant PE companies based out in the US. So why I'm interested in this is because two firms tried to buy it. Two firms tried to buy it at a price that's much higher than what it is trading at right now. So right now the stock is probably trading at at about 380, and the formal bids for the company is at 560. So that's about 50% higher than what the company is trading at right now. So a Japanese conglomerate called Orix tried to buy the entire firm at 560 yen per share. It didn't work out. The shareholders didn't tender enough stock for the acquisition to work. So that failed. So after the acquisition failed, a Japanese PE company bought a major stake in the company, and now they own about 23% of the company. And they bought this stake from the founders of the company. The founders still own a combined 13% stake in the company. So basically, that's what attracted my attention. There are plenty of informed parties that feel that this company and its stock is worth materially higher than what is trading at today from the two formal bids from the founder. Despite the founder selling their stake, the founders still retain a stake in the company, indicating that their expectations of further upside. And there are two other smaller players that also own pretty decent stakes in the company. So the CEO owns 5% of the company. And the parent company of Citrix, like I mentioned, the one that's based in the United States, Cloud Software Group, also owns another 5% of the company. So if you just sum all this up, the founders own about 46% of this company. And we're talking about very informed insiders here, from the PE company to the founders, to the current CEO, and the parent of Citrix. So basically, that is just like the setup of what attracted my attention to the company. It feels that like these informed insiders who basically own where their stakes are owned at a price that materially higher than what the stock is trading at right now, indicates to me that the stock perhaps has low downside risk right now, given that all these informed parties bought at a much higher level.
Okay, yeah, I'm seeing this traded as high as what, 850 in 2020, roughly around there. So I mean, if these guys were offered to buy it at, what was it, 1600?
Mm.
Why
So
didn't?
1600 is the pre-split price. The pre-split price. So we're talking
Okay,
about post-split prices. Yeah,
okay,
yeah. So
okay, okay, okay.
let's we have to I get that right, but we can use the prices like interchangeably because the story is the same, right? But just note that there is a split of 3 to 1, so the stock price is somewhat lower right now. So yes, you're right to have pointed that the stock has traded at a much higher level previously, and perhaps it's good to just spend like just 1 minute talking about why people want to buy this company. Why not earlier, right? Because the acquisition bid was only made about last year, and if you just take a look at the financial performance of the company, it's done exceptionally well. Really, it used to be a distributor of software, and including Citrix, and you're talking about ROEs of like 30 to 40%, which is unheard of in the industry, really. So basically, just a very, very well managed company has been around for decades, and the founders used to run it, and now they have since passed it to the current CEO who started in about 2019. So why last year and not earlier? It's because the company executed a transformational deal that changed the business model of the company. So what it used to be, it used to be simply a distributor of a software. So as a distributor of a software, what you do is you just buy these software licenses, right? And you keep an inventory, and then these licenses are then resold to end customers in In the case of Citrix, it's mostly sold to a government agency. So government agencies, municipalities, banks, and whatnot, regulated industries. I really like Citrix software. And again, we'll go into that a little bit later as to why they really prefer it. But as to now, the story about how the business model has changed. So initially, just a well-performing software distributor. And in March 2025, the current CEO executed a transformational deal. So in this deal, Ascentech became the operating partner of Citrix in Japan. And what operating partner means in software parlance means that it became what we call a master distributor. A master distributor. So the difference between a master distributor and a typical distributor is that the master distributor doesn't keep licenses in its inventory. It basically owns the contracts with long-term customers. So you can see that the master distributor perhaps keeps all the long-term customers for itself and passes off the smaller one-time off sort of customers to its other distributors. So as a master, like a distributor, you have all the power to make the business model better. So in exchange for this privilege, Ascentech will pay the parent, a CSG, a cloud software group, a fee every year, every year. So the fees consist of two parts, really. So there is a recurring fee that they will pay for this privilege to be a master distributor. And on top of that, there is I term it some sort of a one-time transformation fee that will be done in roughly 3 years. I think it's going to be about 17 billion yen, and they are paying about 4 billion a year, so that'll be done in about four years. So what happens in this huge business transformation is that your margins will improve dramatically because you are no longer buying licenses at marked up prices from the parent. You are essentially the parent in Japan. So you're buying these licenses at what we call wholesale prices, right? So you're buying a lot cheaper and selling it at roughly similar prices, but at longer term contracts. So the margin improvement is something like 10% operating margins previously as a typical distributor to 15 to 16 operating margins by 2028 as a master distributor. So that's where the business transformation is. So it's not a coincidence that when this business transformation deal was executed in March of 2025, the first formal bid to buy the entire company came months later, right after the deal was executed. And a few more months later, the PE company came to buy the 23% stake in the company. So plenty of informed parties feel that this business transformation deal is the real thing here, and it will materially transform the economics of the company.
So, just so I can understand, why, since this is so beneficial to Ascentech, why would Cloud Software Group do this? Why wouldn't they just keep selling them the licenses as they always did?
Sure. So that's a fantastic question. So again, that's one of the first areas that I looked at, right? If the economics are so great, why not keep it all for yourself? Why pass it over, right, to somebody else? So I think what happened was this. So Cloud Software Group is a large software group that owns plenty of softwares, and where Citrix is one of their more dominant brands in its portfolio. So what I realized they've been doing is that they've been trying to simplify their business structure. So as great as the economics are for Cloud Software Group, they are not based in Japan. They are not a Japanese company. And anybody who has done business in Japan would understand that it has a very unique sales culture. It's very, very conservative, very, very relationship driven. So sales cycles in the Japanese economy for software is actually a little bit longer than what you would see compared to the US, Europe, and the rest of Asia. So in which case, cloud software group may not enjoy this type of margins that Ascentech has, simply because it's not a Japanese operator. So in its effort to simplify its own business structure in the US and the rest of the world, it felt that creating this Japanese operating partner structure would be most beneficial for its transformation.
Okay. And Ascentech, they were distributing Citrix, and did they have any other software of their own which they were selling? And are they still selling this other software or distributing any other software?
Right. So many years ago, I feel that many years ago when I checked out on these statements, it did distribute other types of software, but I would say that Citrix became the dominant product that it distributes. I would say starting in the early 2010s. I feel that the statements really just spoke about Citrix since then, and didn't quite mention other types of software products. So ever since Citrix became the dominant software product for Ascentech to distribute, it has sold other products that complements the Citrix offering as well. And now it might be a good time to sort of speak a little bit more about into the product. So Citrix, even though it's a software, even though it functions like SaaS, you actually need specialized hardware to contain it for its customers. And why hardware is where this story becomes very, very interesting. Because what Citrix does is the biggest demand of Citrix software comes from regulated industries. So we're talking about banks, hospitals, government agencies, and whatnot. And what regulated industries need, particularly in Japan, is that data is regulated to be localized, that it cannot live anywhere else. So for those who perhaps have a lighter idea on how SaaS works, for SaaS, your data lives on a server, right? Your data lives in a central server, so all your customers could access it. But for regulated industries, your data cannot exist in cloud servers. It has to exist in a physical server, in a physical office, say at a bank, at a hospital, or a government agency. So what Citrix does is, first, it ensures that, so it forces the government agencies and these banks and hospitals to first host their data first in a centralized location. So that's where the hardware sales are. And Citrix software itself allows any employee, any authorized personnel to access the on-premise data securely from their own devices, say from a mobile phone or from a laptop, or if they're working in an offsite office. So what Citrix software really does, and where the name comes from, virtual desktop infrastructure, is the data doesn't move. The data doesn't move from the on-prem location. Citrix software simply just takes a picture of it. Think about it as taking a photograph of it and then transmitting it to the end user's device, say a mobile phone or a laptop. So if the end user makes changes to the documents, the Citrix software takes a picture of what changes has been made and then transmits it back to the on-prem servers to update it. So Citrix is really infrastructure software in that sense, that it allows end users to access on-premise data securely. So hence there is the hardware setup component, which is mainly like a one-time setup cost plus maintenance fees going forward, and the SaaS subscription fees going forward. So there are two parts to its revenue.
Okay, no, you can definitely see the need for that then. And I was going to ask you, I mean, this virtual desktop or this thing, is it such a unique thing? And, can this be disruptive in today's age of vibe coding and whatever? Is this something that can find competition in the future, or?
Yeah, sure. So the way I thought about it is like this. So in this age of AI, we've been talking a lot about the disruption, right? So hence a lot of large SaaS companies haven't done too well, like Workday and
Yeah.
Salesforce. I don't think your audience needs reminders of that. So my framework is actually really simple. So the idea is people switch when the benefits vastly exceed the switching cost. And I think that's a very simple framework to get, right? So if your benefits is just a little bit higher than your switching cost, you probably don't want to switch, right? You
Yep.
will only do it when your benefits vastly exceed the switching cost that you have to endure, right?
It has to
So
be
in
10
which
times
case,
better.
I would say it has to be 100 times better. I don't know, a million times better. Really, I don't think 10x meets the cut anymore. Really, because there's a lot of steps that when it comes to using your software, right? If you're like a senior leader of a corporation, it's not just the cost that matters, right? It's about retraining your entire workforce. Can you imagine how much time and
Oh, God,
resources
yeah.
that would take to retrain them to use an entire piece of software? So you better make sure that the benefits vastly exceed like this training and resource costs that would be associated with your switch before you actually do it, right? So these are what like business leaders are actually thinking about. So the way that I think about it is that if your software relies on logic, the benefits will probably exceed the switching cost. Now, when I say logic, what does that mean? So if we talk about like a software like Salesforce or Workday, so what they really do is that they simplify your workflows, right? They simplify your workflows, whether it's Workday in HR functions, recruiting, or Salesforce in customer relationship management, which is essentially like a large like a database of customers' data. They simplify your workflow. They pull in every data into one spot. Everybody can access it easily. Everybody can edit it easily. You can see the updates. There's an audit trail. You can connect Salesforce or Workday software to other third-party software. They will further enhance its functions in analytics, database management, and whatnot. So in a few sentences, this is what logic software competes on. But there are other types of software which I would say like is pretty sort of niche software where even with AI disruption, that the benefits are only like incremental. That they won't take an evolutionary step like what logic a software would experience. And basically, in at least in the case of Citrix, there are real physical constraints to users using the software. Okay, what does that mean? And if you go back to the earlier part of the discussion, I mentioned that Citrix basically just takes a picture, right? Data in servers, and then it takes a picture of whatever the end users do, right, with it. Now, how these pictures are taken, simple, managed by the software. But how are these pictures transmitted? They are basically transmitted in the same way that internet data is being transmitted, right? There is through servers, and anybody who knows about infrastructure would understand, or anybody who experiences a slow internet connection will understand that there will be bandwidth constraints in it. There are real physical constraints to how fast the pictures that Citrix takes that will be transmitted between the end users and the server. Now, when there are real physical constraints like this, it also constrains what can be built, what can be optimized in it. So earlier we talked about logic, right? If Salesforce just simply sort of makes your work easier, that constraint, there's sort of very little constraints on it. There are plenty of ways to make your work easier and better, right? But when you're physically constrained by bandwidth at servers, you have to work within these constraints. So in which case, AI will probably generate simply incremental benefits, to alternatives of Citrix, but they would generate revolutionary benefits to users of logic software. So in a nutshell, that 10x, 100x, 1000x benefits that we see will probably be more applicable to software where logic is the key engine instead of bandwidth limits being the key engine. So if you differentiate between incremental benefits and revolutionary benefits, that Citrix is unlikely to be disrupted by AI. That would be clear.
So, I mean, I guess then rather than AI being a risk, then it would be a competitive product like you had mentioned to me, Microsoft's Azure.
The Azure product, right? The Azure product has
Azure.
been free actually, and it is a competitive. It's a competing software product. So there are only two other big VDI competitors in this. So Microsoft offers a free product, and the other one is actually by, let's see, it's a it's VMware. It's VMware that is
Mhm.
owned by Broadcom. That's based out in Singapore. So VMware used to be public, and then Broadcom
Yep.
bought it. So here's the thing. I would say that the real competitor is really just VMware. Because Azure's product, despite being free, has not slowed down Citrix's growth. So Microsoft offered a product in the mid 2010s, and that hasn't slowed down the growth of Citrix software at all, really, despite being free, not really. And it's mainly because of this. From what I understand of Microsoft's competing product, it can only deal with data that lives in the cloud, So which means that regulated industries will never look at it, right?
Yeah.
But if you are just lightly regulated, where only part of your data needs to live on-prem and the rest of the data can live in the cloud, then the Azure product will make sense for you. I think for lightly regulated industries. But for heavily regulated industries like financials, healthcare, and government, that wouldn't work really. So the only real competitor is really VMware that's owned by Broadcom.
Yeah, no, you're right. And even though it's 2026, I was talking to the head of IT of one firm, a 100-person firm, and I said to him, why don't you guys do this in the cloud? And he's like, no, like his boss wants everything on premise. And so there's still a lot of companies out there who I think really don't want to have any risk of, some, of or perceived risk of the cloud. And one other risk you had mentioned to me was if there's some sort of change in the terms or, but that seems highly unlikely considering that CSG are, they're shareholders, so they also benefit. They want to simplify. They're not interested in Japan individually.
Yeah, exactly. And I do think that you highlighted one of the key risks of the story because Ascentech would depend on what the parent of Citrix wants to do, right? It really depends on what CSG wants to do. But I also think that you answered the question not perfectly. It's highly unlikely that CSG would do anything that would do anything detrimental that to damage this deal simply because they are 5% owners of Ascentech and they have every incentive to see Ascentech succeed. So and given that the deal is going well, is going smoothly right now, and what's important to know is that CSG is not betting on an amateur here.
Yeah.
They are betting on a distributor that has demonstrated expertise and success in distributing Citrix software and establishing like these great relationships with customers. And that is what prompted the deal in the first place. It feels like a win-win deal for me that Citrix gets all the upside of running Japan, yet without the downside of operating locally in Japan itself. And again, Ascentech wins by really upgrading its EBIT margins, operating margins, just simply being like a very knowledgeable local operator.
Let me ask you something else. I know very little about Ascentech beyond what the presentation I saw and just
Sure.
looking around the internet. I saw like in the last quarterly results, And I'm sure if someone who's listening to this podcast goes and sees the financials they'll be wondering, well, revenue is down and gross profit is down. What's going on there?
You're right. It's actually terrible, really, and I do think that is one of the reasons what caused the stock to really fall, really. But it's actually widely expected by company insiders, because what happened was quarter one last year is what we quarter one last year had what we call like plenty of one-time sales and profit actually, because quarter one last year quarter one last year was the quarter that captured many of the benefits of the transformational deal.
Okay.
So this deal has been, I think, it's been happening for years. It's been in the works for at least two years now. So imagine that if you're in the seat of a customer, you're trying to renew your Citrix license. You're trying to think to yourself, okay, should I renew this with CSG? Should I renew this with Ascentech? They're still working this out. So in which case, you're sort of delaying the renewal of your license. So after the deal was executed, there was a rush in renewal of licenses. So quarter one of last year sort of captured this dynamic here. So you are capturing the dynamic of the renewal of existing licenses. You're also capturing the surge in new licenses too. So new licensees must wait for a bit because they shouldn't do it with CSG, right? They have to do it with Ascentech. So in which case, quarter one of last year captured this dynamic. So you can see that 4 quarters before quarter one last year, there's a gradual ramp up in sales, and after quarter one of last year, there's a gradual decline in sales. So this basically just to say there's a one-time phenomenon right here. So okay. That leads us to today. So today's quarter one, in 27 quarter one, faced some very tough comparables from last year. Very, very tough comps, really, because of the one-time sales phenomenon. So in which case we are seeing this headline declines in revenues and profit. And I've talked about revenues. It does affect profit a little bit too, because as I said, new customers have to invest in hardware too, right? Invest in hardware too. And I think Citrix actually makes pretty high margins on its hardware sales right here. So in which case there is another one-time boost to profit margin as well. I believe that operating margin is probably in the high teens last year, and fast forward to today, it's probably in the low teens right now. So it's really like a one-time phenomenon simply because of the transformation. And the good news is that in subsequent quarters, in the coming quarters, the comps will become a lot easier going forward. As I said, quarter one of last year is the peak, so it should get easier this year. And the thing is, there is no institutional coverage of this stock. There's no sell-side equity coverage of this stock. So this is about 100 million USD market cap company. So in the Japanese market, this is almost an entirely retail-driven stock here. So the sell-off was most likely due to the headlines that retail traders read, but sort of didn't quite go deeper to analyze. And that's where our opportunity lies in today.
Well, yeah, I mean, I did notice this because actually, before yesterday, I think I opened up and I was like, oh, what's consensus on this? And I was like, nothing. So
yeah, there's nothing.
Since there's no institutional coverage, are you just forecasting, doing your own sort of estimates for growth and margin going forward?
Yeah, sure. So in the case of Ascentech, after you sort of understand the story, right, you would have come across that the new CEO Matsura. When I say new, that means that he's not a founder, but he's a veteran. He spent like at least 1 decade with the company before becoming CEO. And when he became CEO in 2019, you would have realized that he has never missed guidance before. And this is actually pretty rare anywhere, not just in the Japanese market. So what really this implies is that his guidances are conservative. That's the message that I got from him. If somebody keeps beating guidances, they are probably being very conservative, right?
Yep.
estimates. For Ascentech, we can actually follow these management estimates really. So fortunately for us, since the business transformation, it has given Ascentech, it has given estimates for the next 4 years up till 2030. So this company is trading at the market cap is about 15 billion after the earnings drawdown recently. So at 15 billion, it is projecting a net income of about 1.4 billion at the end of this year, which is the next fiscal year of 2027. So we're talking about a 10x PE, right? About a 10x PE right now for a dominant software provider with recurring customers, where there's only one other competitor and informed parties thinks that it's worth a lot more. Okay, so 10x PE is very, very reasonable for all of these factors, right? But you should get a little bit more excited for how guidance looks for the years beyond that. So for fiscal year 27, net income is projected at 1.4 billion. And for fiscal year 28, it's projected at 2 billion. At 2 billion. So that's a 33% jump in net income there. So 2 billion versus like a 15 billion of market cap today, there's about a 7.5x PE for the next for like a 2 year forward, a PE, right? That seems very, very cheap. Again, very, very cheap for what we for all those factors that I've mentioned. And you know what? On top of that, for fiscal year 28, the ROE is projected at 25.6%. 25.6%, 26%. And anywhere else in the world, 26% ROE is fantastic by any measure, really. By any measure, it's amazing. And you can get it at about a 7.5x PE. And you know what? Guidance also includes forward dividends too. So for this year, the dividend has already been confirmed at 45 yen per share. The 45 yen per share is not adjusted. It's not split adjusted. So if it's adjusted by it's 15 yen per share. 15 yen per share. Sorry to get everybody so excited. So 15 yen per share for about a 350 yen per share stock. So that would be a 4.3% dividend yield.
Yeah, 4%.
4% dividend yield right now. Okay. But you should get a little bit more excited because for the following year, for fiscal year 28, they are expecting your dividends pre-split to be at 64. I'm looking at 64 right now. So post-split, there'll be about a 21.3 yen dividend. So
5.7.
A 21.3 yen dividend divided by 350 will give you about a 6% dividend yield 2 year forward running. And the only reason why I'm so confident in their guidance is because they've never missed it before. They've never missed it since CEO Matsura took the helm in 2019. And there are projections for fiscal year 29 and 30 that will make the stock even cheaper. That will make the dividend yield even higher than 6%. But I'll let your listeners check it out for themselves in case I make them too excited.
Yeah. So basically, what you're saying is that you trust this management. They've always beaten.
You're not really going to add anything by doing a lot more work valuation wise or estimating, forecasting.
Yes, exactly. And because first the management is proven, like what I've said, the CEO is proven, and more importantly, the company is proven too. Just whip up any financial data provider and take a look at how the company has performed before the transformation deal was executed in March 2025. The ROEs are incredibly high, And for a software distributor, it's pretty amazing, really. And it's really a combination of local expertise, lean management, as well as the dominance of Citrix software. So the company doesn't hold an investor day, but some earnings presentations are longer than others. So in my view, it doubles up as an investor day. So if you go to the IR website, which is actually all in Japanese. So there is an English version and a Japanese version. And I advise everybody to actually look at the Japanese version and have your browser translate it to English. Because believe it or not, the Japanese version has more details and more timely news than the English version. The English version always lags the Japanese version a little bit, and sometimes excludes critical information that the Japanese version has. All right, so look at the Japanese version and then have it translated into English. And there will be a section of the site that showcases the earnings calls, and you will know when you are there because those are YouTube video links, right? Those are YouTube video links. So when you click on it, you will see a picture, a small picture of the CEO actually reading from a script and going through the earnings presentations, slides. So some of these slides are available for download, but not all of them are actually available for a download.
This under, because I just did this, that what you said, I fell into the same trap where I clicked on English and I wasn't finding stuff. But now you are right. I can really see that there's a lot more info if we just go to Japanese, have it translate. I just found it. It's under IR information.
Yes,
so
exactly.
IR information.
Exactly, yeah.
Yes.
Exactly, that's it. Yeah. IR that information. So you'll see the links to the video transcripts. You'll see the CEO actually reading. It looks like he's reading from a script and going through the earnings call slides. And in the latest full year earnings call, the latest full earnings. So earnings are reported 4 times a year, but he only does these calls twice a year. So at the 6-month mark and the full year mark. So in the latest full year mark, you'll see the Vision 2030 being presented together with all the guidance metrics that I speak about.
Okay. I'm actually just opening this up. I see it can open up in YouTube. I wonder, yeah, it gives you the captions. So you can change the captions, auto translate.
Exactly.
And I guess you can watch this.
That's exactly what I did. I watched it with like the captions auto translated in real time, noted down what I could, got Google to gave me the transcript in Japanese, have it translated once again, and go through it again, just to understand what is it that he is saying. So what I spoke about for Q1, where like the comms are terrible because the Q1 for last year had like plenty of one-time sales, is also fully explained by the CEO in the latest Q1 call as well.
I see.
Yeah. Yeah.
Actually, you know what? I'll take probably a picture from the website and I'll put it in the Substack article so that people will know what we're talking about.
Nice of you to do it. You know, you expect people to find it for themselves, but this is very typical of Japanese small cap companies, where they keep detailed versions of the Japanese sites and less detailed versions of the English sites. And some Japanese small cap companies don't even keep an English version, right? So it does take some digging into it. But most Japanese companies, they report pretty well. They follow like a standard format, so it's comparable across companies. So that's the upside in analyzing those. Ascentech is the first Japanese company that I've ever invested in. So I went through all the financials as detailed as I can, and I do think that it's well reported for a small cap firm.
Now, one thing I noticed, because I was thinking about the stakes, the CEO, you mentioned this, had a 5.2% stake and he has not sold. How did he acquire that stake? Was that given to him or did he buy it?
Right. So before he became CEO, I think he has been in the firm for like 20 years. So I think that there's definitely some share-based compensation, and Japanese companies are actually notoriously frugal in terms of giving out a share-based comp, unlike the US. So what I was expecting is he didn't receive any share-based comp for at least say like 75% of his career. It's only when he's promoted to, I guess, more senior management that he's given share-based comp. And I think that when the business transformation was about to happen, he was given more like incentive, compensation as well. I'll not be surprised if he's given some by the founder or by Cloud Software Group itself. I didn't audit the trails to find out. So I would assume that most of it is incentive, share-based comp received in a much later part of his career.
And sort of to recap that, we have Keystone, which bought at 560, We have CSG, which bought at 551. We have the CEO, who still holds a substantial stake. The founders, which sold some at 560, but still hold together a 13% stake. So that gives us roughly, and I think you mentioned this to me, almost half of the shareholding is amongst these insiders, which must believe, therefore, in the business and the company.
Yeah, right. In fact, you got all of that right. I will just correct and refine one part of it. That is, Cloud Software Group bought its stake at about 551 pre-split. So post-split is actually 184 per share. So they are most in the money right now. They are most in the money
Okay.
because they were issued the stake. They bought the stake. I believe 6 months before the transformation deal was executed, before the large increase in its share price.
Okay. Okay.
And you got the rest of it right. By the way, Keystone bought at 560. Two founders sold part of their stake at 560. CEO didn't sell, and then Cloud Software Group bought at 184 split adjusted and 551 pre-split. So that's exactly right. Yeah.
So what do you think would be then a fair valuation for this business?
Right. So the way I look at it is, if we just look at, so as I've mentioned, that the company has never missed guidance, right? So we should probably go off the guidance for 2028, which is like 2 years later. As I said, this year's full year guidance is impacted by like the elevated quarters last year, right? So I think that 2028 would be like the first year where you can see the full impact of the business transformation. So if you look at full year 2028, they are expecting 2 billion in net income, which represents 25.6% ROE, very very high. So the implied EPS is 143 yen per share. So now if you just think, and I guess the last one to add to that, that represents like almost a 6% dividend yield to the current price today. So if you think about some of the qualitative factors that really matter here, it's first, it should be worth at least the 560 yen per share that the two PE companies try to buy, right? So I would say that is like the floor, right, of the business at 560 yen per share, and business is about trading at 380 right now. So I would say that a fair valuation for this, besides in addition to knowing that that is the floor of the stock price, the way I think about it is Citrix is one of two dominant VDI software providers, because we have mentioned that the free product provided by Microsoft Azure, though free, doesn't really apply to regulated industries. So in terms of regulated
Yes.
industries that represent the biggest customers for Citrix, really only Citrix and VMware would matter here. So we're talking about one of two the dominant software providers. And talking about regulated industries, first, the barriers to entry should be kind of high, right? Because you have to go through rounds and rounds of approvals, and the company has to approve it, the regulators have to approve it, every other vendor has to be able to connect into it. So in which case, new entrants should find it increasingly tough to break into a business like this. Plus, incentivized management. I think that this business is worth at least 15 PE, and I would pay a 20 PE for this business. So if you look at 2028 net income, that is 2 billion, right? About 2 billion in net income. So if you slap like a 15 XP to it, that will be a 30 billion. 30 billion in market cap, and today it's about 16 billion right now. So that's really 2x even at 15x PE. But if you consider that this is a 25-26% ROE business that's probably growing at least low to mid single digits, with room for margin expansion, because the company actually sells its own proprietary products to pair with Citrix. So with the advent of AI and the combination of AI and on-prem regulations and requirements means that it's going to be more complicated to run AI on on-prem Citrix systems, which the company would sell proprietary hardware just so that these regulated industries could run properly. So in which case, those proprietary products also have higher margin too, right? So when this business transformation is fully completed, the company should be able to sell more of its own proprietary products, in which case it would improve its margin profile, in which case the ROE should trend higher from here, from 25% to even to the low 30s. So in which case, for a low 30% ROE business with recurring customers growing at low to mid-single digits, I would say a 20x PE seems very, very reasonable. Seems very, very reasonable. And a 20x PE at 2 billion net income would be 40 billion, right? In market cap compared to 16 billion today. So you are definitely looking at like almost like a 2.5x return from here. So I would say that at least a double, and the bull case will be 2.5x. And it will come, I think, very, very quickly after the comparables get easier throughout this year. And recall that this stock doesn't have any institutional coverage. So no sell side is covering this. So no sell side is telling you that the quarter one last year is elevated because of one-time sales. So no sell side is telling you that. But if you look carefully at management's comments for latest Q1, they actually tell you that. They actually tell you why in the press release. It's not in the earnings call because it's a Q1 and not a half year or a full year. So you'll learn that in the earnings slides, and you'll also see that they actually break it out. They try to break it out what their core business looks like, excluding the one-time sales, which is unprecedented because this company has never quite presented its earnings in this way before. So management is sort of aware of what it needs to present as well. But I think that there are reasons why management may want to send back its guidance like this, even though it's confident of growing. I think the company has always been managed from a very, very conservative stance, and it wants to maintain its credibility of never missing a guidance. So therefore, it never has to cut guidance either. So it wants to establish its and maintain its credibility that way.
Have they said also anything, just out of curiosity, one on free cash flow, because I'm a big fan of free cash flow, and two, if they've said anything about like their number of customers or number of subscribers or something like that?
So in terms of, I answer the second part first because that's easier. Just in terms of number of subscribers and actually the names labels of top customers, they actually did not release that because I think these are, I think it's all fully expected that they are all government agencies, hospitals, and banks. And Japan is notoriously conservative as compared to US and American culture. So no really means no. So when the regulators do not want their names or earnings calls, like they really do mean it. So I guess that's why the company has not published any list yet for any customer list yet. In terms of free cash flow, I would say that kind of distorted for it has been distorted for the past 2 years now because of the working capital changes that is associated with the business transformation. And just to be very clear, the business transformation does involve transfers of these long-term contracts that CSG has with big Japanese customers, and now those contracts are being transferred to Ascentech right now, since Ascentech is the Japanese operating partner of Citrix. And when we are talking about these long-term contracts, they involve plenty of upfront payments, right? So that in turn would distort working capital inflow. So in which case, I actually don't have a good idea on how free cash flow will look like post transformation. So I would say that it's best just to follow management's guidance that they did according to GAAP. And since they already established credibility in not missing guidance ever since CEO Matsura took the helm, I think we should take a lot of comfort in following management guidance there.
Okay, no, makes sense. I mean, there's a lot to like here. I mean, it's clear, like, now that you've shown me that they have these videos, the Japanese website,
Yeah, on the Japanese version of the website, exactly, on Japanese version.
they have so much. They have that's a lot of credibility in my book, because it looks like, it sort of ticks the corporate governance criteria, because I think that's important. And nowadays, people don't pay enough attention to the corporate governance. Having founders,
Mm-hmm.
having a CEO, having some sort of disclosure and information. So I think that's super important. It seems pretty obvious. There's people interested in this thing at higher prices. So it seems kind of my take is that the downside is sort of limited, and you
Exactly.
have a lot more upside, and you can just sit around and get paid like a bond until that upside comes about.
You have just outlined my investment philosophy perfectly, which is to limit the downside, limit the downside first, and then enjoy the upside. Always limit the downside first. And I guess one thing that's actually supportive of free cash flow that would be very interesting for your audience, which presumably are American and European audiences, is that Japanese companies are also notoriously frugal in paying out share-based compensation. So in which case, whatever operating margin that they announce is real operating margin, and whatever free cash flow margin that they eventually would guide to and announce are real free cash flow margins. So you don't really have to adjust for SBC anymore. In which case, the cash flow profiles are very, very clean.
That's fantastic.
Yeah,
I mean,
exactly.
really, this is so good. What can go wrong here?
So I would say that I think we did go through right a few things a few things that we sort of like debunk, but it's good to sort of like mention that again. So one is, will CSG, the cloud software group, make the term so onerous that Ascentech's business is no longer economical? So we've already sort of debunked that because CSG owns 5% of Ascentech, so it's unlikely, right? Even though it has all the power to adjust the contractual terms and disrupt the business. But because of 5% stake, I think it's unlikely that it would do that. So that's one we talked about. Second thing is, will Microsoft's free VDI product disrupt Ascentech's business? Well, we sort of debunked that by saying that the product was invented in 2015, it was given away for free, and yet it hasn't stopped the growth of Citrix as well as its competitor VMware. And the main reason is that the free product only works in the cloud. So in which case, regulated industries cannot use it anyway. So that's one reason why Citrix and VMware in Japan have not slowed down their growth even with the introduction of this free product. So I guess the third risk factor, which may be more likely than the first two things to happen, is what if execution fails here? I mean, we're talking about a pretty significant business transformation here. I got right. But I think that if you look at the historical performance of Ascentech, I think you can also quickly debunk that, because even before the transformation, Ascentech is really really an excellent IT distributor with incredible metrics. You can see that the ROE is in the low 30s, sometimes in the high 30s. So this is a lean and mean operation that is supported by Citrix dynamics here. So one must work with the other. So local management expertise works with the economics of Citrix software itself, meaning that it's difficult to displace it. It's really one of only two softwares that you can choose if you have on-prem data that's regulated and must stay at particular locations, and when you need your employees and vendors to access the data offsite. There's really only one of two choices here. So it's really the dynamics of Citrix plus like the expertise of local management that gives me comfort that they do possess like the background to execute like this structural transformation properly. Other things, other risks, I would say that if the PE firms are paying attention, the first Japanese conglomerate, Oryx, failed right in its bid. will it come and buy the whole thing again? Come and buy the whole thing again. Now the stock is a lot cheaper, right? Right now. So would Oryx just come in and just say that, oh, let me just pay like 40% more, and it will be kind of similar to what I've bid for the company in the past. So that, I would say that there's some sort of a risk as well, because if that happens, this is no longer a compounding story, right? You will get your returns, but it'll be sort of like a one-time rocket sort of returns, and you don't see and you don't see like anything else like beyond that, right? You also don't get like the subsequent years like a dividends, too, right? So it is returns, but returns will be capped, right? And the PE firm Keystone that already owns 23% of this can buy more, right, of the company, reducing a liquidity for minority shareholders and whatnot. I don't think the founders would sell anymore, really, because the founders have been in the business for decades. If they wanted to cash out, they would have cashed out at the time that when Keystone was interested in buying their stake. So I don't think that founders would sell. It's unlikely that the CEO would sell. I think he's banking his entire personal fortune on this, so I don't think that he's going to sell any of his 5% stake. In fact, I won't be surprised if he has the chance to buy more, really, at this price point.
The founders did sell about 20% out of their 33.
Yeah, it's not big, really, but the fact that they retain a significant portion of their stake means that they think that there's further upside to come. In this, and I don't think that they will sell any further. Any more risks, I will let you know when I think of that. I don't think there's no sort of the typical risk that you see the other companies. There's no competition risk here. Okay, first there's no competition risk. There is no substitution risk. Customers are not going to leave this product because there's only one other alternative out there. And I've explained why I feel there's going to be little AI disruption risk, because this is not a software that competes on logic. This is a software that has to work within physical constraints of bandwidth and server limitations. So whatever AI can bring in, the benefits will be incremental because the whole function of the software is limited by physical infrastructure. So in which case you hit this ceiling where you simply just need more higher performing servers to work, just like how AI is working right now. The reason that why NVIDIA chips are so popular, because they hit this ceiling, right? In order to perform faster, it's no longer a logic problem. I need more chips so that I can run faster here. So they have hit that physical limitation too. So the same story really applies right here. So in which case, there'll be little AI disruption risk. So there aren't any of those typical risks that is hard to ascertain, hard to determine, hard to forecast that you see in like other software names. But everybody thinks that this thing might be disrupted from somewhere. That's why it's trading at like what it is right now, 8x. A 10x PE next year, 8x PE, 2 years later, 6% dividend yield 2 years later. So it seems that this is like just a very, very safe stock where like your downside risk is very limited. The floor is really set by like the formal bids given by Oryx and Keystone. And it seems that the upside is yet to come, really. And management has only guided like a glimpse of that.
Oh, that's fantastic. I think you pretty much summed that up.
Amazing.
So, if people listening want to check it out, the ticker is 3565. It trades in Japan. Now, Marcel, I know people want to get to know you. I think you've written a book.
Yes, I have. I published it in March. So if anybody's interested, please leave me a review. The point of the book is to sum up the principles I've learned that I have consistently relied on in terms of making good decisions under uncertainty, not just in stock investing, but in life itself. And I was fortunate that Peter Kaufman was a mentor in the earlier part of my life. And Peter Kaufman shared one of his favorite note-taking principles that he learned from Charles Darwin. And Peter mentioned that you always have to write down notes when you first read something. And after you compile the notes, you got to write up your notes, meaning that you read through all your notes again, reflect on them, and see if there are any repeatable themes that that go through your notes. Presumably, your notes would comprise of knowledge from different domains. So by stringing together principles that have worked across different domains, it's more likely that they will work again in the future. So this book is my attempt at writing out my own notes to identify principles that have worked across the domains and across time. And I really hope that some people will find this useful. I've also written the book as a conversation between three people, as a three-way dialogue, so that the knowledge flows, I think, a lot easier, and it showcases how wisdom is being acquired mainly through by asking questions, objecting, and then answering those objections rather than me presenting it like a lecture. So anyone who is interested, the book is available on Amazon.com right now. The title is kind of long, so the best way to search for the book is just to search for my name, Marcel Gozali, on Amazon.com. You'll find the book.
Because I'm going to put this on the Substack as well. So within the Substack piece, I'll put a link to the book, which is Wisdom: How to Think and Judge Well in an Uncertain World. I'll also put a link to your website,
Sure.
stonescap.com, so people can go and read your letters. Is there any other way people can reach out to you if they want to?
Sure. So I have an email that is on my website, and if you finish reading the book, there's actually a link at the end of the book that goes to my website as well. So I have an email on the website that people can reach out to me at, and I look forward to hearing comments about the book or my letters or others. My next letter will be published. I write a letter every quarter to my clients and friends, and they are usually published about 10 days after the end of the quarter. So encourage everybody to read it, and I'm looking forward to comments.
Thank you. Thank you, Marcel, so much for doing this once again. I love listening to your ideas, and I think this is just one of those ideas where, like we said, limited downside, get paid while you wait. And I just love that. I love your philosophy. It makes a lot of sense. So thank you. I hope I'll see you in September. If not in September, maybe I'll see you next year in Shenzhen, perhaps.
Sounds good. Well, thank you so much for having me. It's a pleasure for me to share my ideas on your platform, and I hope we do this again.
Podcast episodes should not be copied, distributed, published, or reproduced in whole or in part without the prior written consent of the host. These recordings are for informational purposes only. This recording does not address all risks. The podcast is not intended to be relied upon as a forecast, research, or investment advice, and are not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. The views and opinions of any podcast participants are subject to change and are not necessarily those of any companies affiliated or associated with the participants. The participants cannot guarantee the accuracy of the information in this podcast and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. There is no guarantee that any forward-looking information will come to pass. Reliance upon information on this podcast is at the sole discretion of the reader and/or listener. Past performance is not indicative of current or future results. This podcast is being made available for educational purposes only and should not be used for any other purpose.